everyone. I'm Ted Oakley, managing partner at Oxbow. And this being our last interview for the year 2023, I think I may have saved the best for last. Certainly glad to have Michael Belkin of the Belkin Report. Michael, glad to have you.
Thanks so much for having me, Ted.
And Michael goes a long way back. He started trading back in 1986 at Salomon Brothers, for all of you remember that name. Called the top in the Japanese market, 1989, called the top in the tech market, called the bottom in that market, called '09 bottom. I mean, he's called a lot of things. And just recently got out of the markets in late 21. And I remember just this past year in October 22, he thought we would get a good trade up through this time. Then he was right on that. And he's got a different tune today. But Michael, I'll start out by just asking you how you see generally how you see the markets right now.
Okay, good place to start. So I think the major, the biggest influence on what is going on right now is the economy is headed down. Okay, and I've been long bonds, TLT, T-bonds, since October. October 19th was a major bottom in the bond market in prices, top in yields. So the free market, the Fed, if we go back and think about how we got here, I guess that's a good place to start. So, COVID hit, the stock market traded down 35% or something in the NASDAQ. They threw all kinds of stimulus, an insane amount of stimulus at the economy for no good reason. I think it was all exaggerated. They shouldn't really have done it. It ended up being 37% of GDP between fiscal stimulus and monetary stimulus. And it's just such a huge number. So, stimulus checks and et cetera, et cetera. So then, the Fed interest rates were, at zero then, and the Fed's pumping money like crazy, and the government's mailing out checks. And of course, inflation takes off. So 2021, 2022, inflation starts taking off, and the Fed says, oh, it's transitory. We're going to keep interest rates down. And of course, that was dead wrong. And then they raise interest rates by, I think, 525 basis points ultimately. And inflation peaks at 9% in the CPI. And then inflation has peaked about a year ago. It's like 18 months now, June 2022, I believe, June, July. And so inflation has been falling. And that's kind of been a sweet spot for the stock market, right? So the bonds didn't really bottom until October. Then the stocks and bonds bottom, and they've been rallying. So I think we're past. Long story short, the good news has kind of been baked in. So the market has feared Fed tightening, right? And of course, we sold off sharply in 2022 because the Fed was raising interest rates. That's all anybody seems to care about, what the Fed is doing. So now it's been 21 months now since the Fed started tightening, right? Since the Fed started raising interest rates, and generally the lag in monetary policy is about 18 months. So I think we're hitting big time a major inflection point in the economy. So and one of the things I do in the Belkin Report is press clips. I just want to read a few headlines that I've been clipping here for next week's report. So here we go. A severe recession may be coming in 2024 as the stock market, job market flash warning signs. U.S. producer price inflation cools to below 1% as energy slides. I'm short energy stocks in the moment. The Economist magazine, Europe's economy is in a bad way. Policy makers need to react. Here's China. Xi disappoints investors by skipping signal for big stimulus. UK's economy shrinks in October, signaling weekend to the year. German GDP to contract 0.5% in 2024 due to budget crisis. Eurozone industry output falls by more than expected in October, blah, blah, blah. So, I mean, I don't want to belabor the point, but that's what I'm seeing. It's just like, it goes on and on. That's global. And in the US, so what I do is forecasting. And I have a proprietary algorithm that I developed based on my studies at UC Berkeley Business School before I got into Salomon Brothers. And it's a form of time series analysis based on Fourier and Box Jenkins, the mathematics behind that stuff I learned in the stat department at Berkeley. I came up with a novel way to approach it. So I have a forecasting technique that looks at direction, position, intensity, 12-period forward forecast. So all my stuff for the economy points down big time. Industrial production, retail sales, employment down, and not just the rate of change, but level. So we're headed into a recession, right? So, and one of the things I've learned having, I was at Solomon from 86 to 92. I've been doing the Belkin Report ever since. That's like, what, 31 years now? Gee.
1 years, yeah. And gained a lot of business too. I know I think the people that you counsel have like 2 trillion in assets or pretty close to that, which is,
wealth funds, private banks, in Europe, big insurance companies, hedge funds, asset managers all over the place. And everybody, I'm not the Pied Piper, I'm not saying follow me, do everything. What I do is I provide a probability matrix, and I try to help people think and comprehend about how things are going to change and how they should position for that.
And don't you look too a lot, Michael, at the difference? You'll look at like 3 months and 12 months. You sort of separate that a little bit, maybe. At least when I read, I get your report, so I know what you do. But it seems like you have a real good sense of change. When something's changing, you do that really, really well. And I think you're talking change now.
Right. So I frequently look pretty crazy at turning points because the market's doing one thing and my forecast is saying the opposite. So I'm looking at a forecast, not at what the screen is doing at the moment. But usually I'm not 100%. This is not like something where you want to land, the space shuttle 99.99999%. It's not like that. But it does, the model, it likes to buy low and sell high. And it's not just the market, it's all these sectors. So a lot of what I do is sector analysis and then stocks within sectors. So the Belkin Report has a buy list and a sell list. And so that's getting back to your point about, what my outlook. So it's just overwhelming right now. Defensive stuff wants to outperform the market. And so if you look at, this is not absolute terms, but in relative terms. So you say take staples, consumer staples, utilities, or real estate REITs relative to the index. You do a ratio of that, and then I do a forecast for that, and it points up. So alpha, you want to have alpha, going forward 3 to 6, 12-month view, overweight utilities, staples, real estate, and financials. Actually, that's a new one. Okay, brand new last couple of weeks. Financials really depressed. And if you look at all of those in relative terms, they're all down. Like nobody likes financials. I was short banks before, but
and don't all those tie into interest rates sort of in general? I mean,
yes.
You've got your interest rates going down, that would benefit that group you're talking about. Yeah,
they're interest rate sensitive, particularly banks, and financials. So it's not like I think there's going to be a big rally, but those are chicken longs. I'm talking, like people don't, most of the time I tell my clients buy utilities and they go, what? I mean, it's not like exciting. This is not a go-go momentum thing at all. So the flip side of that is, so what's supposed to underperform? And so this is pretty controversial and it's not exactly working yet, but I have these Mag 7 stocks, Google, Alphabet, Meta, Amazon, Microsoft, et cetera. And I include Netflix in that. So it's really Mag 8, just because it's one of the FANG stocks. I have those top. So if you look at, in absolute terms, I have a tentative top in those November 28th, which is a ways back now. It's almost a month ago, 3 weeks. So those stocks, people are really overweight. They're crowded. It's a crowded trade. Everybody knows it, and they still look good, I guess, to stock analysts. The earnings look okay. But if I'm right about the economy, so industrial production, if all this stuff's going down, and of course the PMIs have been negative for a long time now, right? The manufacturing PMIs have been below 50. And I think it's just starting to catch up. So basically, the forward earnings estimates that Wall Street relies on to value stocks, I think, are just ridiculous right now.
On the earnings side, if you were extrapolating that into, say, a number on the S&P, maybe you don't do that. I'm not certain, but they've all got these numbers out there next year, like $230 and 240. And for us, we look at that and think, man, I don't know how they're getting there, but they're certainly optimistic. And if you look at the overall, it's like that. And I'm assuming yours is a good bit less than theirs.
I think they've got the wrong digit in front, not a 2, more like a 1 something, you know. So ultimately, by the end of the year, of course, why do earnings fall? So that you've really put your finger on the whole issue about for the stock market right here. Okay, if earnings fall, I've seen this again, 31 years doing the Belkin report. So there's been several big recessions along the way. Okay, particularly let's just look at like 2000 tech bubble top. Then the market was lousy for a couple of years, and the economy went down. Not massively, but earnings fell, and the Nasdaq fell 90-something%. 2007 peak, you know, the credit crisis peak, earnings collapsed. Both instances, the S&P fell by 50%. Not overnight, but just in a kind of a waterfall. You know, where bear market volatility goes up, you get sharp rallies, but then it fades and goes to the lower lows. So I think the mentality right now in the market is, oh, good. Like today, we have a Fed meeting coming up. I don't know what it's going to be yet. And everybody's sitting on the edge of their chair saying, oh, is the Fed going to cut rates? Because lower interest rates are always bullish for the stock market. Okay? Right? That's what everybody thinks. I say wrong. If you go back and look at 2000 to 2002, 2003, also 2007 to 2009, the Fed cut interest rates dramatically, earnings collapsed, the stock market went down 50%. So that the market has this psychology, you know, basically I think it's thinking the wrong thing. People have, particularly since 2009, a lot of young traders haven't been through a down cycle yet, where they see where the economy weakens and interest rates go down while earnings go down and stocks decline. So there's real mental, you know, something, you know, there's a hurdle here, a psychological change that I think is going to happen. And it's not there yet because the algos, everything are programmed to say, oh, the Fed, you know, dot plots are down, I'm so bullish.
It's interesting you talk about the people around since '09, because we espoused that all along, that you have this whole group of people that have basically just done plug and play for 13 or 14 years, and they buy 11 indexes or ETFs, and we're off to the races. That group, I think you just said, is going to suffer in this downturn because they won't know what to do.
Exactly. So what do you do? You know, the rotation to me is starting to look a little bit like after the tech bubble peak. Nothing's ever exactly the same, and I hate overlaying one chart with a chart from another period and saying it's going to do exactly the same thing. There's similarities, you know, the market's something, it's always different. But what I'm seeing in the rotation, and a lot of what I do, the model is best on sector rotation. Okay, it's proved itself over and over the years, 30-something years. And there's a lot of information about the market, not just a directional forecast for the S&P 500, but what's going on beneath the surface, you know, in the nuts and bolts. And so what do you do? Like if the sectors are going to, if defensive stuff is going to outperform, you know, what do you do? In 2000, there was this period where utilities outperformed massively, financials outperformed massively, consumer staples outperformed massively, while tech was going down big time. And I think we have something that we're setting up for something that rhymes with that. Everybody's so overloaded, overweight these FANG, you know, Mag 7 stocks. And I think as the earnings forecast, you know, the way this works, the dynamic, again, I was at a sell side broker, but Solomon Brothers, I remember how this works. So in a down cycle, all of a sudden the companies announce, oh, we're not going to meet the earnings forecast. Like Oracle did that. So a lot of big companies are doing that. Taiwan Semiconductor, a bunch of companies are saying, you know, your estimates are too high. We're not going to match it. So then what happens is the Wall Street analysts who have pie in the sky say, oh, we're going to lower our rating on the stock. And then the portfolio managers that are just follow the leader go, oh, the analyst downgraded this Meta stock. It's time for me to sell Meta stock. So then it gets into this dynamic of snowballing to the downside where, you know, the companies warn. And then also on the fundamental side, when the companies warn, you know, that they're not going to meet their forecast, then they start cutting orders, right? So that's what drives the economy down. So their suppliers, they cut back on their suppliers. The suppliers then say, oh, we're not Taiwan Semiconductor is not buying so many semiconductor manufacturing machines from us, so we're like downgrading. So that's the way it works. And it's not the end of the world. It's just a down cycle. It's just how the economy works, economic cycle.
I was going to ask you this: does this period remind you a little bit of the first quarter of 2000 when you had made a high at the end of '99, and they tried to jam in during that 90 days up through March and made a minor new high, but it was actually the top. That was it, and nobody recognized. So you did, but it's interesting that we look sort of similar, like that. The feeling is like that right now, I guess.
I totally agree with that. And the Wall Street Journal did an interview with me. Michael says it to the Wall Street Journal at the time, and there was a story. They said Michael Belkin sees a lot of crap out there, and I had come up with this name, CRAP, companies without revenues and profits. And there's a lot of those, in the so-called disruptor software world. These companies that are supposedly going to change everything and revise everything. That's kind of stocks that Tiger Global was long. And at times I'm bullish on them. I do what the model says. I don't argue with the model, right? So the model says they're going to outperform. But now, those things have kind of had their day in the sun. And right. So
you went bullish on them in October 22.
Also energy. So energy is interesting. So earlier this year, energy, that was my favorite long, and the stocks went up massively. And again, this was something people said, Belkin, what are you talking about? Energy stocks, everything's ESG. It's not, why should we buy energy? We're all going to be windmills, and blah, 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 and solar panels. And of course, energy stocks that was the place to be earlier this year, first 6 months of the year. But now that has changed too. So again, cyclicals, I'm underweight. I say to sell and short energy stocks on bounces. I've been there for a couple of weeks now. Everything economically sensitive, I just think you got to look out. And so again, bonds. So bonds, they're a little bit overdone. They're up for like 14% TLT since October 19th. But I would buy, if you can lock in almost 5% on a 30-year bond yield or 10-year bond yield, 4.5 now, something like that. That's a great deal in an economic down cycle, where inflation is falling. So that's one of my favorite long positions. It remains that.
I was going to ask you on this market, but before I leave the market, I wanted to ask you what type of bear market or sell-off do you see? A fairly strong one? How do you see it? As something like a collapse that would be, fairly high percentage on the negative side, or what are you thinking?
I'm not entirely sure, but so sentiment is really important. Okay, so over the years, I've seen people. My first clients were, Steinhardts and Tigers of the world. I left Solomon Brothers, and I thought, oh, I'm such a great forecaster. I have these wonderful, the world's most famous investors as clients. And then gradually I saw what these guys do, that they would like crowd into things at turning points. And my model would always be saying the dollar is topping, and these guys would be pushing up the dollar. And, the lieutenants would call me and say, oh, Stan is saying, go through Merrill Lynch. We're all like trying to make the appearance of something happen. They just try to squeeze people in and they get too bullish or too bearish at major turning points. And that's the reason I say that is it's very important how people are positioned. And I've seen it over and over. When people are completely long and optimistic and positive, they get squeezed out. That's what makes markets go down. And they could go down for quite a while. And it kind of sorry, this isn't PowerPoint, but like a zigzag pattern, like down, lightning bolt, down, up, down, up, down, up, down, up. So a good trading environment, but bad emotional environment, like bear markets, emotionally, when I'm not looking at the model, I always feel like, oh, it's going up. I should buy, oh, this is a bull market. And then it reverses, it starts going down, and it goes down for like 5 days, and the market's down 5 or 10%. I say, oh, it's the end of the world. I got to short them. And then that's the bottom, and you get squeezed. So I think you have to watch out for that. You want to be contrarian in terms of positioning. So you can have these big rallies, 10, 20% rallies in bear markets, but you want to be selling at the, not right at the beginning of them, but after bounces. So basically sell rallies, and then go short and try to, make money on the downside or not get hurt if you're a long only manager. So I think it could go on for a while, and I think it could go down in big percentage terms. I think this is a major top, and the economic weakness and earnings collapse is what's going to drive the market down.
And when you say major percentage, you mean like greater than 25 or 30?
Yes.
Yeah.
I mean, that's just ballpark. That's a normal bear market.
Yeah,
So
that's what I think. A greater one is 40 or 50. But, and it's interesting right now, the complacency, and I know you see this in your work, but the complacency level, you look at the volatility indexes, or you look at the people that are buying very little protection on the downside right now. Everybody thinks that you don't have to worry about anything. It's all done now. You find that true?
Absolutely. Two data points on that. So the AAII, Association of American Individual Investors, the percentage, they have a percentage bulls and percentage bears thing. I've been following that data for years and years. The percentage bears just hit a 6-year low. You have to go back to 2018 to find a number that low in the 20 something percent, below 30. And as you said, the VIX. So there's selling options. Like, I don't know who sells options, but there are dedicated funds that sell options, and that's what's partly been driving volatility down. But that means that actually they make options cheap, and it's a contrarian thing. So I think actually put options are not today, options that expire in a day or a week or something, but more like out 3, 6, 9, 9 months, and significantly down, like to maybe 10% below the market. Are extremely cheap right now because of this ridiculous decline in VIX volatility.
Yeah, and so you really would be generally raising cash or selling the market in general. I know there's some things you like long too, but to own as well. But you would have liquidity plus you'd own the bond. You own the long bond, the long treasury.
Right, and for portfolio managers that are long only, which a lot of my clients are that, there's these big, humongous asset management companies,
Right.
I don't want to give any names, but guys that run, big numbers.
Yeah.
And they have to be fully invested all the time, or not fully, they can raise cash to a certain level, but they have constraints. They can only do certain things. So for those guys, it's this defensive. I think that the only game in town is going to be buy defensive bond proxy kind of stocks, financials, like I said, utilities, staples, and even real estate investment trusts, which are kind of controversial, but they've been, they've been slammed in relative terms. They're unpopular, and some of them will go bust. You have to be careful about which ones you buy, but you can do these with ETFs. So, right, there's an ETF for real estate investment trust, XLRE. There's a staples ETF, XLP. There's utilities ETF, XLU. So you can avoid some of the individual stock risk by going into those. And one other thing I want to mention: gold stocks. Okay, so gold stocks outperformed in that period from 2000 to 2002, something like that. Over those 2 or 3 years there, gold stocks outperformed the S&P by almost 300%. It was a huge number. So when the Fed starts cutting rates, gold starts taking off, the dollar starts declining. That's positive for gold. So that's another thing to look, as well as the defensive utilities, things like that. Gold stocks, which is our very inefficient market. I do a retail gold stock report, and analysts don't follow these stocks. I mean, there's not a whole lot of them that are investable, right? Like some of them, there's Newmont and Barrick and things like that. Then there's a bunch of medium-sized ones, Hecla, Coeur, and a bunch of others. I don't want to get into any names, but in most sectors and industry groups in the market, the analysts, there's 10 or 20 analysts for every stock, and it's all pretty much been.
Right.
But gold stocks, I think there's a real opportunity for stock picking, and these are really, really, really depressed at the moment. They've been in a major bear market. Some of them are just down enormously. So I think there's an opportunity there. It's another thing I'd look at.
We take both of your services, which I'd recommend to people to look into. I think the Belkin report, you'd find it interesting in that you get it timely, but on the gold side, you always have, and you have in the other side too, but you always have a list of sort of your top, I think you call them your top top group, or there's another thing you have for it, where you like those particular gold, those gold stocks. And you seem to be particularly bullish on gold and the miners. And I have to agree, you're one of the few people that writes about the names, because I think I'm right on this, Michael, that gold miners are probably, if they're not the least owned group in the S&P 500, they're really close to it.
Absolutely. And so gold tried to break out December 1st. It broke out above its previous high, and it was immediately slammed. I was watching this happen. Chinese buying or something. Gold broke out. It was up 2%, and then somebody stepped on. I don't know who, quote unquote, they were, but somebody really didn't want gold to break out, and so we've had a pullback. I think that's a buying opportunity in the last few weeks. Somebody slammed it down, whoever they are. Could just be a big player, could be a central bank or BIS, or who knows.
Don't you think gold normally will go with the bonds too? Like, at least I've noticed that a lot. If the bonds are moving, positive, the gold will go with it sometimes.
Yeah, so it's interest rate sensitive. If it gets a sense that the Fed, so the macro, one of the things I do is macros, and that's been working really well so far. So I've got a top in the dollar a couple months ago. The dollar is a short to me, looking out 3-6 months. And that has to do with the perceptions of what the Fed is doing with interest rates. So if the Fed is done hiking, and maybe it'll hold for a while, but the forward rates will begin to adjust down as signs of economic weakness turns in. That's bad for the dollar, bullish for gold. So the gold DXY ratio points up. So gold's supposed to outperform the dollar. And as you say, bonds too. Bonds fit into that. So bonds rally. I'm a little cautious on bonds at short term, because they move so far, they could pull back. But again, it's like one of those things, you want to wait and buy the dips. I don't think that bond prices are going to new lows, or interest rates are going to new highs.
Because if I understand you correctly, you're buying the bonds not because you're trying to front run the Fed, but because you think we're headed in a recession.
Absolutely.
Right.
And so we get in this weird paradox where central banks manipulate the monetary system and interest rates and credit conditions and QE and all that. And then you end up with these repercussions, blowback from everything they did last time wrong creates the next thing, and that they have to do something wrong again to correct the excesses that they made last time.
They do a wrong to correct the wrong, don't they? I agree with you totally. And see, you and I have watched this for a long, long time. These people don't remember that Greenspan ran those rates up, in '87, and that's sort of part of what exploded the market.
Absolutely. That was my baptism in fire at Salomon Brothers. And again, I think this reminds me of that right now, where, okay, so I came into Salomon in '86. I was hired into market analysis by Laszlo Barini. I was still in market analysis. I ended up in proprietary trading, quantitative strategist, running the house account with 3 or 4 other people, with Stanley Shopcorn later on. But in '87, I remember the market rallied, kind of like recently, right? Where you have this big, crazy, for no reason move up while the Fed was raising interest rates. Then it topped in August, sold off, rallied back into September, and then boom, the bottom fell out. So it reminds me, again, nothing's ever exactly like anything else. I'm not predicting a 30% crash in a day or something, but we have a similar kind of dynamic where people got squeezed in, and there's this mechanical buying, right? And back then it was portfolio insurance. It was actually instigated my mentor at UC Berkeley, chairman of the finance department, Mark Rubenstein, was the guy behind portfolio insurance. That was one of the things that got me into Salomon, actually, his recommendations for me. But anyways, you had this mechanical buying, and then it turned into mechanical selling as everybody was completely overloaded. So we have that potential again now, where these algorithms have just buy, particularly in the last 2 weeks. It's just, I understand, where is this coming from? It's just.
I know. Well, Michael, I think I read this last week, that Apple, and it listed all the big 7, but Apple was the #1 owned stock, not only for institutions, but for individuals. #1 owned stock. And it's like they're all in the same group here. It reminds me a lot of, if you remember, in early 2000, Cisco and Intel and that whole group, and they paid the price for it, really, because they thought nothing would ever go wrong for them.
Right. It takes a while. That took a while, but it was relentless selling. If you remember, the NASDAQ went down for like 2 years or something, and it just never looked back. I mean, there were bounces along the way, bear market bounces, but I do think that we are setting up with a similar kind of, just the way from people are positioned. They're just such crowded trades in these stocks. And again, they haven't hit a new high. So I have this Mag 7, Mag 8 for me, equal weighted index, and it's below its November 28th peak, even with this market going with it, which is really weird. So these are the biggest weight stocks in the NASDAQ 100 NDX, right? The NDX has been hitting new highs barely, by 1% or 2% lately. But these other Mag 7, Mag 8 stocks haven't been. Yeah, it's very strange.
Let me ask you this: in that regard, you don't have any problem holding cash then either.
No, absolutely, yeah, it's a good but what are you going to do with the cash? So I mean, T-bills, they're what, 4.5%, almost 5%, something like that.
You can get over 530 or so on a 90-day, and you can still get 5, close to 5 on a 1 year. But if the way the sentiment looks, and listening to you, I think that's just what you're saying too. I'm asking the question, but the sentiment now seems to be this, which is waving their finger at you, saying, "Okay, hey, you thought we would have a recession, we never did, so you're wrong on that." I'm talking about what people just say generally to everybody, that we're not going to have a recession, it's soft landing, or no, everything's cool. And secondly, you thought the market would break. That's not going to happen. That didn't happen for you. So don't you think everybody's in that mode right now? It's like, okay, it's the boy that cried wolf, and nothing's going to happen here.
Yeah, sadly, so people like Mike Wilson, Morgan Stanley, and what's his face at JP Morgan, who the strategists have been relentlessly bearish all the way down, and they are discredited. So they're kind of the poster child for what you're talking about. But I actually agree with what Mike Wilson is saying now. He's saying earnings next year are going down. They're going to miss what people are saying. So yeah, you're right. The psychology has dismissed any chance of a recession or a stock market decline, and everybody it's kind of like, reminds me of Stockholm syndrome. You know what Stockholm syndrome is? Is where the captives, if somebody, if you're captured by, you're kidnapped or something, and you start identifying with your kidnappers. So, and you just kind of give up, and you go with what they're thinking. So I think like market psychology has been kidnapped by this idea that soft landing, everything's okay, Fed's going to cut interest rates, earnings aren't going to go down, and blah, 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 blah. And I think rude awakening, that's going to be the title of one of my next reports. Rude awakening is coming.
I want to just say this: we've listed numerous times here how to get in touch and get the Belkin report. I'll just tell you, just from an institutional side too, that Michael does good work, and one of the things I like is that you're realistic, and you're specific on what you are recommending. It's not one of those where you're sort of, just hanging out there and sort of being general. Now, so I'd say that. So I'd recommend to people to think about it if you're interested. We put this on here 3 or 4 times, and we have it again. But Michael, listen, I know you're busy, and I know how much time you put in on your work. So I really appreciate you taking the time to visit with us today. I know people will find it interesting.
Thank you so much for having me, Ted.
Yeah, and maybe we'll try to have you back next year.
All right. Thank you.
All right. Thanks. Hello, everyone. I just want to say, if you like this video and you want to see more of this type of information, because we really try to get the information that you don't see from anybody else, then be sure and click on subscribe, and you'll see more of what we do here at Oxbow.